Thank you very much. Good afternoon, everybody. A half decent set or a 2/3 decent set of H1 figures. Clearly, the EBITDA was not where we want it to be. The sales growth year on year, just shy of 25%, was very good. The cash position, just shy of 11 million, was also very good. So the sales number at 54 million was decent. H1's always a lot slower, but we just didn't make as much profit as we were hoping for. There was a lot of reasons for that, and we can go into those later through the slide. We made a lot of operational changes, warehouse alterations, etc., which hindered us somewhat. We can discuss those later in the presentation. So Trustpilot rating still at 4.8. We're nudging 4.9, so we're really working hard on that. And there's no one else in the industry has got a Trustpilot rating of that score. We've got 40-odd thousand items of products in stock, some 4,500 SKUs. We manage that SKU count very tightly. We don't want to increase it too much more than it is. And we deliver to 90% of the UK population, and we can install to over 70% of the UK population. At the time of this presentation, the end of September, we had 250 employees. We've now got 300 employees. Most of 200 of those are drivers and driver installers. Okay, so the market's worth, all told, TV, MDA, which is major domestic appliances, the TV being consumer electronics. You can see there that it's worth, that's for the half year. If you include vacuums in there as well, it's worth nearly 8 billion. So it's a huge market, and we've got a minute market share. We really have. So the aim of this business is to improve market share. When we floated with Pamela Gordon 2 years ago, we were floated and depicted as the UK's best kept secret, and we're trying to change that via marketing. I mean, that's the way of getting over your brand name, as we all know, and we're improving our market share, and that is through brand awareness. Also, you can see we've got a very good share. We've got split into online and the overall market at the same time, so you can see quite clearly what percentage we've got and how we're actually growing, or you can see the growth we're achieving, and that has been achieved through marketing. The TV market, you can see, is very, very small that we've got at 0.9%, so we really want to drive into that space. We know we've got quite a bit of work to do there. Next slide, please. Financial overview. So Josh will just take this one. So we'll canter through it, and then we can do Q&A, and we'll go in depth into each slide.
So looking at the first half, you can see the revenue grew from 43 million to 54 million. So that was up 24.8%. Order growth was slightly faster than that, at about 30%. So we saw a drop in average order value ever so slightly of about 5%. And we've got our work cut out in the second half to drive that average order value back up. So it's nice having order growth faster than revenue. It's not all driven through pricing, but equally that does have an impact on the distribution costs, which I'll come on to in a minute. EBITDA margin was 4.3%, so not as high as we'd like it to be. We are still growing profitably, so we've managed to do 24.8% growth whilst remaining profitable. But the 4.3% is about 200 bits lower than last year, and that wasn't where we wanted it to be. And again, we'll be working hard in the second half to recover that. Strong operating cash flow through improved working capital led to a good operating cash conversion of 145%. Should be around 100% plus for the full year. And as you know, we've got a good return on capital employed figure. One of the things we were happy about in the first half was we reduced overheads to 5.9% of sales from 6.2% in the first half of last year, and 6.7% in the full year 23, as we benefited from operating leverage, and we do expect that to improve in the second half as well. Looking at the P&L in a bit more detail, we've given a bit more granularity this time in terms of how the gross product margin is split up. So previously we disclosed gross margin, which was both the product margin as well as the distribution and installation costs. We've now split this out in line with how some competitors do it, but also to give people a little bit more colour. So the gross product margin has moved from 25.2 to 24.9, which we would consider to be reasonably stable. And the reason that we're showing this level of detail is just to show that we're not discounting heavily to achieved 24.8% revenue growth. Gross product margin is broadly stable. The reason for the small 30 bips decline is driven by the fact that our TV business is growing quite rapidly, over 70% in the first half, and TV typically has a lower margin than major domestic appliances. So a little bit of a mix impact driving that margin down. And generally we see higher margins in the second half than we see in the first half. So we should expect that overall gross product margin to drift up in the second half. Distribution and installation costs, that's where we felt the pain in the P&L. We went from 7.1% of sales this time last year to 9.1% of sales. And that was driven by three factors, really. The first one was the introduction of our own installation business, where we can now provide integrated gas, electric, television installations on a next day basis with our own team of integrated gas, electric installation engineers. We've obviously invested in the future growth of the business there. It's a really premium service offering that we provide, and it comes with cost. We expect that to improve slightly as the business grows, as we improve density in that service. But in the short term, that had a small impact on the margin that we saw there. The other two factors are, one, we gave a reasonably large driver pay increase. So that impacted the numbers in the first half. And then thirdly, as I mentioned at the beginning, our average order value was down slightly in the first half. So our order growth was faster than our revenue growth. And obviously that means that our drivers have to deliver more. So we're delivering more product and the drivers getting paid more for that because of their wage increase. And that all had an impact on the distribution and installation costs. Advertising and marketing was 5.6% of sales, which was bang in line with the previous year. We expect to bring that down to about 5% for the full year. So we tend to spend a little bit less as a percentage of sales in the second half. And then on overheads, this was where we made some good improvements and reduced it from 6.2% to 5.9%. And we expect that to go down further in the second half. And we'll end the year a bit lower than where it currently is, we expect. So some more margin benefit to come from the overheads and the advertising, as well as a gross product margin. I expect the distribution installation costs to remain roughly similar as a percentage of sales. This is really just a graphical representation of what we saw on the previous slide. So the EBITDA margin went from 6.3% to 4.3% in the first half. The product margin dilution driven by the TV mix offset by the operating leverage that we achieved on the overheads, and the real pain in the P&L coming from the distribution and installation costs, as we mentioned, due to those factors. Next one, please, Matt. Just a little cash bridge here, just to show how the cash has evolved since the March 23 closing cash position. So we closed at 10 million at the end of March 23. We've had operating cash inflows of 3.8 million, which is the profit plus the working capital improvements. We managed to improve inventory days from 82 days to 64 days, which really helped with driving that operating cash conversion. We spent 1.4 million on CapEx, which was up significantly year on year. CapEx was only about £100,000 in the previous year in the first half, and it was 1.4 due to a lot of operational improvements that we've made during the first half, which we'll take you through later in the slide deck. All of these operational improvements to position us for our future growth. Lease payments for our current site, dividends as well, obviously, and tax paid take us to 11.1 million. And then, as stated in our various earnings announcements, we have an ERP replacement plan, which is going on in FY24 and FY25 to replace the back-end operating systems that we run on and replace those with Microsoft Dynamics 365. That had a cash cost of 200k in the first half and a 400k P&L cost. And we expect the total cost of that project to probably be in the range of about 3 million plus. And that will run across FY24 and FY25. Next one, please, Matt. A little bit more on the balance sheet and cash generation. So a net cash balance sheet, as I'm sure you're all aware, with 10.9 million of net cash. We had a closing inventory balance of just shy of 14 million, which was broadly flat year on year. And as mentioned previously, we've managed to improve inventory days from 82 to 64. We believe we can get inventory days down to probably about 50 days, so a little bit more of an improvement from here. We might not achieve that by the year end, but we're certainly focused on improving those inventory days and getting a little bit more efficient at our inventory turn. We don't want to go sub 30 days because we believe that you should be well stocked for distressed purchases. If your fridge is broken, you want a new one and you want it tomorrow. So we feel we'd miss out on sales if we don't have the right level of inventory. Working capital ended up actually being negative, minus 0.2% of sales, which obviously is very efficient. We weren't specifically driving for a negative working capital, and we'll see how that flows in the second half of the year, depending on the inventory balance. But it just shows that if we can get the inventory days from 64 to 50, there is a little bit more opportunity to improve that operating cash conversion.
Yeah, so here, guys, you can see our expanded geographic presence in the UK. So the green area is where we've got our installation offering. That's installation of integrated appliances, built-in appliances. So all the other blue areas, whether it's dark blue or light blue, we can do freestanding installation. So all our drivers are all trained to do the installation of a freestanding dishwasher, washing machine, washer dryer, American fridge freezer. The green area is where we can get where we do the integrated installation. The dark blue plus the green area is where we can do next day delivery and installation of freestanding products. And the light blue area is where we go 3 times a week. So tri-weekly deliveries to parts of West Wales, Devon and Cornwall, and then Glasgow. So you can see the reach where our trucks can get to, and it's all our own deliveries. About 5% is DPD, which is things like vacuum cleaners, small domestic appliances, SDA we call those, so coffee makers, that type of product. But 95% of products are delivered by our own vehicles. Next slide. Here you can see the installation, how it's about a year ago, so August last year, we used to use a third-party company for doing installation. In fact, 2, the manufacturers use these companies still. We decided that they weren't reliable enough. There was a lot of problems with the slots they were offering to the consumers, so we decided to go it alone and start our own installation team, which we did August 2022. Now we've got 40-odd installers, and half of those are gas safe registered, which is brilliant. Albeit gas is a slightly dwindling source of energy, and it's more integrated and electrical installations and TV installations that people are going for. But this has proven to be a real jewel in our crown, having our own installation team. So we set that up in August 23. Now we've got a full-blown team, and that, as you can see there, that arrow's pointing nicely upwards, and that's due to having your own guys that can go and do it the next day. No one else can actually go out tomorrow and install an integrated dishwasher on the south coast, and we can do that. So it makes a big difference having your own guys do this. If you want just a freestanding one product, that's a bigger geographic area. Also, that attracts a higher average order value as well, obviously, and it cements a sale. We also do Quooker taps, by the way, which is only a very small part of the business, but it's another string to our bow. It's very high average order value. You know, the Quooker tap can be something, circa £1,500. And again, it's another great product to be able to install. If people go direct to Quooker's own website, it's about 2 weeks before they can do an installation. So it just shows how we can beat the manufacturers at their own game. Next, please, Matt. This is our ME Academy, which we actually utilise some old showroom space in our warehouse. It's a single site in the middle of the UK, by the way. So we're 5 hours from Glasgow, 5 hours from Penzance. We've only got this one site. So it's very easy to manage. Everyone's here under one roof, whether it's IT, customer service, sales, all the stocks here, the warehouse operatives, the drivers are here, the routers for the vehicles, everything's all kept here under one roof. So it makes it a lot easier to manage. This academy, we decided that with employing our own installation crews, that we needed to get a standardized service, like a silver service, for example, maybe that you would get in a restaurant where you're training everybody in the same manner. So you see there on that left-hand image, two guys taking an American fridge freezer into someone's house, so that door is a bit of an optical illusion. That product will actually fit through there, albeit that is one of the narrowest doors that normally you can get in the UK, that is. So it's a very narrow door and with a threshold strip, all UPVC, so tricky to get in. So we have to show our guys how you actually take the doors off the product and then get it inside the house yourselves with your own crews. And we're trained in, you know, Samsung, LG, Miele, Liebherr, LG, AEG, you know, all the major brands. We're not just doing one product category, one brand, I should say. So for our guys, teaching them how to install all these different brands is not an easy task, but we've made really good headway with it. We're finding the training academy has been brilliant, and it cuts down on your failed installations, because when the guys get there, it's easy for them to do. They know what they're doing. It's a standard service amongst all our engineers, that they all know what they're doing when they turn up. You know, they ring up half an hour before and negotiate the consumer. Hello, Mrs. Smith or Mr. Smith, we've got your new integrated Miele dishwasher in Guildford. We're 25 minutes away from you. Everything okay? And the consumer's like, please, obviously, have the phone call. Then get ready, get prepared for it, and it's training all your guys so they all have a standard service. And we really are finding that's making a difference. You can also see the TV installation area as well, where we're offering installation of large screen TV, well, any TV, but in particular large screen television. Incidentally, the middle image, that is actually a 98-inch television. So we show the guys in our academy, you know, this is what you will be delivering. The chance of fitting one on the wall is quite remote. Not many people will have one on the wall, but it shows them what they could be up against. And it's always best to show all the people that work for you what the worst case scenario is. But if you're training them properly, it just helps them with the job and less issues. Thanks, Matt. Next slide. Josh, so marketing, you see.
I'll take this one.
Yeah, you take that one.
Yeah, so we've been doing a variety of brand building, as you know, for those that followed us since the IPO. The key really was to grow our brand awareness. So we've improved our awareness across television and radio, across a variety of different channels with different types of adverts, some focusing on our installation offering, some focusing on our television offering, and so on. We've done more radio this year than we've done in previous years, which has worked well. We're partnering with brands on both television, radio, and out-of-home campaigns, and that's going really well. So the brands are, you know, very happy to work with us on the types of products that we want to collectively get out there and market to the customers. You can see at the bottom picture on the middle, we've rewrapped our entire fleet. So our fleet's now in this bright blue colour with the robot on the side of it. A lot more eye-catching than the dark grey fleet that we had before. So that's also additional marketing driving around the country every day in our very bright colours, which is great. And we've had an increased social media presence over the last 12 months too, which is again going really well for our brand awareness. We're quite geographically focused on our brand awareness. We've been focused on certain areas in the country, and they've been growing faster than the overall revenue growth, which is obviously showing us that it's working. And we've got plans in the next 12 months to be reaching out into new areas that we haven't pushed into before, and really trying to grow the brand awareness in those areas through out-of-home advertising campaigns, and having an increased focus in some areas that haven't really heard of Marks Electrical. So that's the plans for the next 12 months. Thanks, Matt.
Thanks, Josh. Yeah, so this one's showing how we're improving our distribution HQ here at Boston Road. And that was done through the majority of the summer. So it didn't help having all these operational changes being done. It sort of took my eye off the ball a little bit, I have to say, with letting the buyers go after lower value products rather than pushing them a bit and challenging them a bit more than I would have done normally. When you're dealing with builders, you've got, you know, your living room being rebuilt, your kitchen, your bathroom, your driveway all at the same time. So for some 4 months, we actually had the builders on site, which did cause us quite a few issues. We had to restrict stock flow coming into the business, which didn't help us. You can see there the top left image is a brick wall with some parking spaces in front of it. Now you can see the same space is now dock levelers, 2 nice dock levelers in there. It's tripled the speed at which we can unload lorries and at least doubled the speed on loading vehicles as well. Below the bottom left is some new racking. We've had a process of putting new racking throughout the way. So you can imagine when you have to take all those products out of that area and then put the racking in there and then populate the racking with all the stock. You know, it is not an easy task, and we've done that. New IT office space there in the bottom central image. Having your own IT team, you know, we've got 8 programmers now. I mean, it makes a massive difference in a business. And I've always invested in IT. That's been the real cornerstone building block of this business, whereas not many businesses have, you know, actual coders. They might have a guy that fixes a laptop or 2 or 3 guys that can do laptop option. Ours are actual coders that work for us. Now, the right-hand image, that shows some new V&A racking. We had the aisle space, so it's very narrow aisle racking. And that is only 1.8 meters wide. The existing space widths were 4 meters, existing aisles. So we've managed to condense virtually a warehouse into a third of a warehouse. And that's made a big difference to the efficiency, less damages, the speed of picking. So again, that's given us more space, and we feel like we can get 250 million revenue out of this site. You know, our remit is to get to 500 million and with a 10% EBITDA or circa 10%, 9 to 10% EBITDA margin. So we know we've got a way to go, but that is the plan. That's why we listed the business. That's what we're here for, and that's what we're going to achieve. Hard work. We had a few. H1 was tricky, but things are going very well. So the second half, we feel like we're really going to make big headway. And we've made all these operational changes, and we're ready to leverage that investment. So it's all the building blocks are in place, and let's see how we go. And we've had a great start so far. Next slide, please, Matt. This is metrics.
Thanks, Matt. Yeah, we've covered a lot of the metrics on this slide. Obviously, the average revenue per employee has dropped off slightly as we've added that installation business, obviously in-house in a brand new team of 40 guys. Really changes the average revenue per employee, but we're still operating at a level that we believe is in excess of that of our competitors. So we are still operating quite effectively from an efficiency perspective. The EPS has come down as a result of the profitability, but we do expect that to improve in the future, as we've discussed on the P&L slide. We've kept the dividend maintained. We're obviously one of the few companies out there that have recently floated that has consistently paid a dividend since float, and we're keeping that dividend maintained at 0.3p. Working capital came down quite nicely as we improved those inventory days and made the working capital more efficient. So we actually became negative, which was positive. We're not aiming to push a negative working capital strategy, but it does show that if we were to move from 64 days to 50 days, we could drive it even further negative. Operating cash conversion 145% for the first half, will be around 100% or 100% plus for the full year, and you can see that impact on the net cash balance nicely improving there. Return on capital employed. You all know that we have quite a strong return on capital employed. As profitability improves in the second half, we will see an improvement in that return on capital employed. Obviously, one of the other factors that is reducing it, particularly down from 71% to 49%, is the fact that we've now got cash on the balance sheet. So with the cash, you know, that makes the return on capital employed slightly less efficient, but still a very healthy ROCE.
So outlook. So thanks, Josh, for that. So you can see here, guys, this is the outlook. We feel like we're in a very strong position. We've had a good growth in H1, good cash conversion. So we feel we've done well there, but we've not helped on the profitability. We know that, we're aware of it. We're changing it. We had a great start to H2, and we feel we can still meet those objectives. And it's all to play for in the second half. So fire away with the questions, please.
You've talked about your margin hit as being a result of of investing in the build out of installation and pay rises to drivers. What makes you confident that margin pressure can ease going forward?
Thanks, Mark.
Yeah, sure, Josh.
Yeah, so I mean, as I mentioned on the P&L slide, I'm not suggesting that the 9% on distribution and installation costs is going to miraculously turn back to 7% overnight. I think it'll be roughly the same in the second half at the circa 9% level. And then I think over the next few years ahead, it should come down slightly, maybe to kind of 8.5 or 8%. But I don't expect it to reverse completely back to 7% now that we offer an installation business. It's just a choice that we've made. What we will have to do is to try and make up for that from the overhead perspective. So we need to drive even better operating leverage on those overheads, really drive them down to the circa 5% level in the long run, which will allow the margin at the EBITDA level to creep up. We've been pretty honest on where marketing should be. We expect it should be about 5% of sales to grow the brand awareness. And as mentioned, we expect to see an improvement in the gross product margin in the second half. Generally, for the full year, we should be somewhere between 26 and 28% gross product margin. So more to go for, Matt, but we're quite happy with the direction of travel.
I suppose there's a follow-on question, or a related question, I should say here. Distribution and installation costs together were up over 60% in H1. Do you give a breakdown of the increased cost between distribution and installation? I suppose firstly, and then as a follow-on, if installation services are now at break even, for example, what were the losses in H1 and what would be your expectations for H2 and beyond?
Yeah, so at the EBITDA level, the installation business made a profit in the first half. It's margin dilutive versus last year, because last year it actually it was very small as a proportion. Not many people selected installation because we used a third party, and the customer service and the customer journey was not as efficient. It was quite a long lead time to get an installation. Not many people selected installation at the basket. So now that we can offer it ourselves, that people have that service on, and it is margin dilutive to us currently. But the actual installation business itself is break even, better than break even. Actually, it makes a small margin at the EBITDA level. As density improves and we get better known for offering installation services, and we can do more installations on a run because there's less driving time, because that density is improved, we will see, I expect, an improvement in the contribution from installation there. We've not given the split out between the two, and yes, it did grow at 60% in the first half, but as mentioned, that was partly down to the fact that orders were up faster than revenue, partly down to the fact that there was a driver pay increase, and partly down to this new installation business.
Are the higher margins in H2 than in H1 likely to become an annual occurrence?
Yeah, I mean, that's been an annual occurrence. I think it's fair to say, Mark, for your entire history, hasn't it, over 37 years?
Q1, we used to break even or even lose money, Matt. So Q2 was you'd make a bit of money. So the first half was always, or the Q1 in particular, if you broke even, you were happy with that, and then you'd make the profit in the second half of the year. So it's always been like that. But since we've listed, we obviously try and make a profit throughout the whole year, each quarter. But then this is like the golden quarter, the last 3 months of pre-Christmas. So this is where we need to get skates on, which we are doing incidentally. And this is where we need to catch up.
Thank you. We've got a two-part question here on the enterprise resource planning, ERP. How's it going and when will it be completed? And then what is the total ERP budget?
3 million in 2025.
There you go. It's going well.
Straight to the point.
Yeah.
Can you discuss the competitive environment? Where are your prices versus the main competition? Is your sense that competitors are pricing their products rationally?
Well, the competition need to all start making a profit. You can see that from the P&Ls and the market cap and market values, etc. But the competition have been pretty good at the moment. There's a lot of advertising going out there. There's probably a slightly smaller amount of consumers shopping than there were this time last year. So it's not about giving it all away. We've seen less discounting going on at the moment, which is great. And we're not chasing. We're not going to be discounting. We'll match where we need to match, Matt, but we're not going after. We're actually here to make a profit. a return for our investors. That's what we said we'd do the float, and that's what we're going to do. Going to do, I should say, not going to do. And the competition at the minute are, holding fast. So hopefully we'll see that the prices stay where they are. There'll be a few extra special deals on Black Friday. There always are, but nothing out of the ordinary. I don't foresee at the moment, because people have, the brands have to make a profit.
Thanks, Mark. As you look into the, say, medium term, 5 years ahead, what would be reasonable market share and return on capital employed targets, roughly speaking, in, for example, 5 years' time?
10%.
Yeah, I agree. 10% market share, and I'd say over 50% return on capital employed.
Yeah, that's the aim. We're all set for that, Matt.
Thank you. A specific question here: how many drops does a delivery crew do in a day?
We're not
and
selling
what percentage of those, on average, would be with installation?
We're not going to give away too many metrics because we don't know who's listening. But it's, you can work the sums out yourself of the revenue and average order values. You can see how many vehicles possibly. It's all.
You can work it out, and it varies, doesn't it, Mark? Some of the most dense areas will have really high drops per day, and some of the not very dense areas in the far west of Wales might not have that many drops per day.
It doesn't really make a difference. There'll be some vehicles that go out that don't actually make much profit, and there'll be other vehicles which go to Guildford, for example, and make a lot of money. It just depends where you're going, or the centre of Manchester. Wherever there's a wealthy area, you tend to find it's a higher average order value, but that's not rocket science. That's just information that's out there.
Thank you. A couple of questions here, which I'll just bring together about enlarging your site. And one of the viewers has remembered this has been a comment you've made before about having had a decent runway left of space in your warehouse. Is there anything you can say about the possibility of additional facilities in the medium term if you outgrow your current site?
Yeah, that's still definitely on the horizon. We've been in talks as the property market's softening at the moment, as we all know. So there's more warehouse space coming up for grabs. We've actually seen quite a few potential sites close by. We feel we want to stay here for as long as we can and not jump ship from this site and sweat this asset. It's a great site. We've made a lot of operational changes, and we just need to keep a powder dry and sit here and build up a bit of a war chest should we be ready to move and jump ship rapidly. That's the plan. Get 15 to 20 million pounds in the bank, and if we need to jump ship quickly, we can do so. But we just want to stay here as long as we can, Matt.
Thanks, Mark. I think you touched on this in part, Josh. A question here asking: does reducing inventory days mean reducing magnitude of in-stock items? Does this mean there is plenty of stock of supply in the supply chain? No,
not really. It just means making sure that you're not hoarding too many of one SKU. So we'd much more have a decent spread of every SKU rather than have one SKU and have 400 of them.
Yeah, there's plenty of stock to go around, Matt.
Would you consider coming to the market for funding? And if not, why not, to finance additional growth? We don't need it at the moment.
I don't think we need it at the moment. We've got a net cash position. We're investing nicely in advertising to grow the business. So no, I don't think we need the funding.
Yeah.
Well, on advertising, that's the segue to the next question. One of our viewers has seen advertising recently on the London Underground and at Stansted Airport.
Yeah.
They ask, have you significantly increased spend on advertising?
No, we're still holding there at 5%, Matt. Well, it's 5.6%, but you see I'll go down below 5%, probably circa 5% by the end of the year.
Do you communicate on your MDA average selling price? And is it fair to assume that the average selling price will trend down as you grow towards your £500 million long-term target?
Well, I mean, the market's still 8 billion. It's a pretty big market to go after. And we're selling distressed products at the end of the day. People's washing machine breaks down. It just depends, really. I mean, you want to be always trying to upsell products, and as the quality of your website improves, you can get over the method and the reason why someone should spend more money on a premium product rather than a basic product. So, we want to sell more Miele and Bosch, Siemens, Samsung, etc., than we do Beko and Indesit, for example, albeit we're not neglecting those consumers. So even at 500 million, the market's still enormous. And people like value for money. People don't mind. We've seen that. I mean, people used to years ago just spend £200 on a washing machine. They're quite happy to spend over £1,000 on a washing machine. And going back, 5 years, 10 years, people wouldn't have dreamt of that. They just wanted the cheapest thing they could get their hands on. People see the value of it now. Like the television market, it was generally speaking, without being sexist, the guys tended to spend a lot more money. They'd spend £1,000 on a television, but they want the cheapest washing machine they could get. Whereas now we've seen that turning on its head in a way, whereas, everyone looks at why they should spend more money on a product. Do you want your food looked after better within your fridge freezer? If so, you need to spend more money on a better quality refrigeration product. Do you want your nice, expensive shirts washing in a decent washing machine, or do you want them in a cheap product? So people will spend money if they can see a reason why there's added value in an appliance. So it's our job to educate people why they should spend more money and upsell them. It's like, there's no brand in the world that doesn't make more money out of the premium product. So all brands want you to sell their premium product, and we're incentivized to push premium product and sell premium product. So probably a long-winded answer to the question, but I just wanted to elaborate a little bit more on it.
Thank you, Mark. There's another sort of follow-on just on ERP again. Has the ERP project works had any temporary adverse effects on business operations so far?
No. Zero.
Very clear, thank you. You rightly emphasise that you're debt-free. Could you comment on long-term advantages this may give you in relation to competitors? For example, do you think this allows you to offer lower prices or less expensive installation? And what about the inability of non-debt-free competitors to maintain operations and market share?
Yeah, well, I mean, it does give you the ability to sort of, if ever there was a race to the bottom, we've got the lowest overheads and we've got cash in the bank, so we'd be advantaged. But the brands are very careful with the pricing of their products. They don't want them slashing, and a lot of it's controlled by sales out allowances, SOAs, these are called. It came predominantly from the CE, consumer electronics television market, where you would buy a product and you would get an allowance back from Sony, for example, every time you sell one of their TVs. But then that's if they want you to lower the price, and they control the price through these sales out allowances. And that's done in the MDA market as well now. So there's not one retailer can go out there and sell an American fridge freezer at $499 if they wanted to, because they'd be losing money. I suppose they could do, but how long are you going to carry on doing it for? And the brands wouldn't allow it. Maybe some of the very unheard of peripheral brands, but the big brand names, Samsung, Bosch, LG, Siemens, all the big brands are all very well policed by the suppliers.
Thank you. One investor recalls that you previously have discussed employing senior people from companies like Toshiba to help grow TV sales, and asks simply, so far, has it worked?
Well, Toshiba's one. I mean, I don't think we might actually be selling a few of them now at the moment, but I think we've almost come away from them. It's all about really staying with the big brands and building up the loyalty within those big brands. We've done it with major domestic appliances, MDA, so now's the time to do it with the consumer electronics. And in all honesty, the big brands have got a massive market share. Samsung have got a 30% market share. So we don't need to reinvent the wheel with them. We can just go and chase some of their revenue. And the same with LG. Panasonic have got a very small percentage of the market. Sony's is more than Panasonic. And then you've got Hisense, who've got a fair share as well. So it's all about backing the right horses, basically. And we've got a TV buyer solely focused on television now, and his metrics are all stacking up very well. Margin, average order value, revenue. He's hitting all his targets, and we just need to keep on growing it, albeit we are at a very, very low level still. but we will grow it
Thank you.
profitably.
In the journey to 10% market share, which cohort of competitors are most likely to lose market share to yourselves? Is it likely to be the independents or the large incumbents?
John Lewis and the likes of small independents, probably. The ones who are, they've been in business and then they want to try and leave it to the children. The children have got no interest in really taking on a sort of outright corner shop. They want to move into other careers. So generally they own the building, they sell the building, retire. So there's lots of that going on. The Mamas and Papas stores closing. And John Lewis are neglecting the consumers. They're converting a lot of the stores into office space or even apartments. And they weren't particularly good at that part of retail on domestic appliances anyway, because they use the suppliers' delivery services, which are not very good. You can't go on John Lewis and pick a next day delivery. They don't do it. So we'll see. They'll be the ones that will lose out, but they're not really that bothered, I don't think, anyway. That's how it appears.
You touched on it in your remarks, Josh, but in terms of geographic penetration, what would you consider to be the biggest incremental opportunity region in the UK? Do you have plans in place to address the untapped market there?
We don't really want to discuss all that.
No, I mean, there's, we've talked at length in other presentations how we've been very good at growing our presence in the London area, but there's loads of other areas to go after in the country where we've barely touched them from a marketing perspective.
The Isle of Wight, we don't go there. The ferry's too expensive. I'm being facetious for that comment, sorry, but I mean, wherever the chimney pots are, I mean, that's just common sense. That's where we'll head, as any other retailer in the UK does.
Right. I think we might finish where we sort of started, with a couple of final questions on installation. You're at above 70% now coverage on your installation offering. Is the plan for this to go much higher, or are you planning to keep it at similar levels as today, if that provides the best economics?
Yeah, we'll stay where we are, Matt, for now, and just get better density of installation. Instead of getting so many vehicles, so many jobs on each vehicle, if you get one extra on each vehicle, that makes a big difference. And then try and just keep growing it and growing it. More density, less driving time. That helps us with the getting more value on the vehicle.
Thank you. Maybe one final one then. What would you say is the main benefit to you of the installation offering longer term? Is it to help boost top line by driving incremental revenue, or is it as a differentiator of service versus your competitors?
Both.
Both.
Yeah. It's not rocket science that if people can get something installed, they'll, generally speaking, the wealthier people will spend more money on installation. So therefore you're securing a higher order value on that product.
I think there may have been one last question sneaking in, which I think I've just about got time.
Sure, yeah.
In year of lack of pricing freedom, are there any other levers you have to pull? E.g., would suppliers even consider moving to consignment inventory, whereby they would retain ownership of product until it sells?
I mean, there's no model like that currently that I'm aware of currently. I mean, Miele used to do it in Australia, where that's exactly what they would do. But for some reason, they never tried it in the UK. It just didn't quite work properly for some reason. I'm not sure exactly why. Probably the way the population is distributed. But we're quite happy doing it as we do it. If it did move that way, we'd be best placed because we've got our own installation teams, which is a jewel in the crown, and our own, all our own vehicles, which not many people have. The manufacturers don't have a lot of home delivery vehicles like we do. So we are in a very good, strong position.
There's been a couple of questions on competition, but this is quite a specific one. Do you regard AO World as your most important or effective competitor, or would it be others?
No, not at all. I mean, AO is a very good business, so we full respect for what they're doing. They're had a reshift of how they're running it, and it seems to be doing very well from what I can see. We don't really look at the competition. We're not really interested in what they're doing. We're just going to continue paddling our own canoe, not looking over the fence, checking out how green next door's lawn is. We're not really interested in that. It's all about being aware of what's going on in the market, but just continue what you're doing. I mean, some of the viewers might remember when there was Currys and AO, Currys and Comet, I should say. AO came along and took Comet out completely. You know, and it's, you know, John Lewis are there and they're faltering somewhat. So you just got to get on with your own business and focus on what you're doing and run it properly. And the numbers will then speak for themselves.
Great. Well, on that note, I think that's it for questions. So that just leaves me to thank our viewers for their time and their questions, and to thank Mark and Josh for this very interesting session. And we wish you the best for the peak trading season. Thanks, Matt. Thanks very much indeed, everybody. And
Thank you, Matt.
For you. And we're trying to be quick with the answers, just to canter through it all, because it's nice to try and answer everybody's questions. But thanks for some very good questions, and appreciate you listening in.